What interest rate will the US Central Bank set in 2025? The Federal Reserve Bank, or Fed, is the central bank of the United States. Its main job is to keep unemployment low and to keep inflation under 2% per year. To reach these goals, the Fed, alongside its governor Jerome Powell, sets an interest rate. The current interest rate is 4.5%. The future interest rate is based on three factors: production, inflation, and the political outlook. Firstly, the Fed looks at whether production in the US is at a normal level. This can be, for example, done by analyzing the unemployment rate. Currently, the US records an unemployment rate of 4%, which is below the long-term average of 4.5% when the effects of the COVID pandemic are excluded. More people working means that more incomes are earned and spent, and more goods and services produced. A look at gross domestic product, short GDP, which is another measure of production, confirms this. GDP in the US is higher than we would expect based on its long-term trend. The high level of production suggests that the US economy is currently overheating. In such a case, the Fed sets a high interest rate to cool it down again. Secondly, the Fed takes a look at inflation. After high inflation rates in the last 3 years, inflation was only slightly above target at 2.7% in 2024. Yet, inflation has been trending upwards again since October. To reach the inflation target of 2%, the interest rate has to be reasonably higher than the inflation rate. A higher interest rate makes investments less attractive, making demand go down. Lower demand leads to lower prices, resulting in lower inflation. Although the interest rate of 4.5% is well above the inflation rate of 2.7%, recent increases in inflation might motivate the Fed to increase the interest rate further. The Fed has to also consider the political outlook. On November 5, 2024, Donald Trump won the US elections, proposing tariffs, tax cuts, and immigration limits as part of his economic agenda. Firstly, the US are highly dependent on imports, and introducing tariffs, taxes on imported goods would increase the cost of these products, leading to higher prices for consumers. Secondly, cutting taxes would leave people with more of their income to spend, which would boost demand for goods and services. However, since supply can rise quickly in the short term, this increased demand would push prices higher. Lastly, reducing immigration would shrink the labor force, making it more expensive for businesses to hire workers, which would also drive up prices. To conclude, the Fed considers production, inflation, and the political outlook for determining the future interest rate. Production in the US is at a level above normal right now. An interest rate higher than the current one is necessary to bring production down to a normal level. The current inflation rate is slightly above the target of 2%. It has been increasing again over the last 3 months. Trump's policies will also raise inflation. To lower inflation, the interest rate should be increased. Taken together, the Fed will likely increase the interest rate to about 5%, considering the hot economy, inflation above its target, and anticipating Trump's policies to come. A remaining question is, will the Fed be able to increase the interest rate without political interference? Trump has stated that he knows best how to set the interest rate and has criticized Fed Governor Powell multiple times for his policies. Time will tell how independent the Fed remains in light of such a powerful political opponent.